The 1920s were a time of great economic prosperity in the United States. New technologies like the automobile and the radio were changing the way people lived. The stock market was booming, and many Americans felt like they were getting rich. People were eager to invest in the stock market. They saw their friends and neighbors getting rich, and they wanted to get in on the action. However, this prosperity was built on shaky ground. Many people were buying stocks on margin, meaning they were borrowing money from their brokers to buy more stock than they could afford. This practice inflated stock prices far beyond their real value. The market was a bubble waiting to burst. When it did, the consequences would be disastrous. The Roaring Twenties were a time of great excitement, but they were also a time of great risk. People were living beyond their means, and the economy was built on a foundation of debt. When the stock market crashed, it exposed the fragility of the system. The party was over, and the hangover would be long and painful. October 24th, 1929. This date would forever be etched in history as Black Thursday. On this day, the stock market crashed, sending shockwaves throughout the world. Years of speculation and overinvestment came crashing down. The Dow Jones Industrial Average, a key indicator of the stock market's health, plummeted by 12.8%. Panic selling ensued. Investors, desperate to recoup their losses, flooded the market with sell orders. However, there were very few buyers. Prices plummeted further. Banks, heavily invested in the market, began to fail. Businesses, unable to secure loans, were forced to close their doors. The crash had a devastating impact on the American economy. Millions of Americans lost their jobs and their homes. The unemployment rate soared to over 25%. Breadlines became a common sight in cities across the country. The Great Depression had begun. Today, in 2025, we stand at a crossroads. The global economy is experiencing a period of rapid technological advancement and interconnectedness. While this presents incredible opportunities, it also carries inherent risks. As we navigate this new landscape, we must heed the lessons of the past, particularly the 1929 crash. There are striking parallels between the economic climate of the 1920s and the current situation. We are witnessing record levels of wealth inequality, fueled in part by a booming stock market. The rise of cryptocurrencies and meme stocks echoes the speculative frenzy of the Roaring Twenties. Additionally, the ease of online trading and the availability of high-risk financial instruments have made it easier than ever for individuals to expose themselves to significant financial risk. While these similarities do not necessarily guarantee another crash, they should serve as a stark warning. We must avoid repeating the mistakes of the past. The 1929 crash offers invaluable lessons for safeguarding our financial well-being. First and foremost, we must understand that speculation is not investing. Investing involves careful research, due diligence, and a long-term perspective. Speculation, on the other hand, is driven by short-term gains and is often based on emotion rather than logic. Second, diversification is key. Spreading your investments across different asset classes can help mitigate risk. The old adage, "Don't put all your eggs in one basket," rings truer than ever in today's volatile market. Third, financial literacy is crucial. Take the time to educate yourself about personal finance, investing, and the economy. Understanding the fundamentals of finance will empower you to make informed financial decisions. Finally, remember that history has a way of repeating itself. We must remain vigilant, learn from the mistakes of the past, and make sound financial decisions to protect our financial futures.